And although it did not happen today, the trend lately has been that when bond yields fall, stocks tend to do the same. Investors are just trying to decipher that seemingly odd relationship. Right now, some see stocks and bonds as frenemies. Mike Santoli explains.
Stocks and bonds have a complicated relationship, and lately, bonds have been firmly in control of it. The steep drop in bond yields this month has knocked the stock market off balance as investors view the rush of 10-year treasuries to 3-year lows below 1.6% as a worrisome sign for economic growth and the Federal Reserve's ability to support the expansion on its current interest rate path. The recent pullback in the S&P 500, which at its worst last week fell more than 6% from its late July record high, got rolling just as the 10-year cracked below 2%. Even on a minute-to-minute basis, declines in yields have weakened share prices, while nearly the entire 3% bounce in stocks over the past several days has occurred at times when yields have stopped falling and lifted off their lows. And yet, it's not entirely the case that low yields are all bad for stocks. Low rates act to support equity valuations on a relative basis, making stocks appear cheaper compared to bonds than they have since the sharp sell-off in late 2018 and before that in 2016. A majority of large stocks now have dividend yields higher than the 10-year Treasury, as does the S&P 500 itself, which now has about a 2% dividend payout. Very low yields have boosted more stable defensive stocks such as utilities and consumer staples, along with very big growth stocks with strong profit potential seen for years to come without reliance on a hot economy. Now, this probably means the best setup for stocks at this point would be a modest lift in yields that allows more cyclical sectors and financial stocks to recover from sharp losses, while easing some of the more intense fears of recession that the yield collapse has fueled. For Nightly Business Report, I'm Mike Santoli.